which looked rock solid relative to what happened in the previous quarters. There was a quibble maybe on the margin front, you could argue, a slight miss on the bottom line front relative to what Bloomberg estimates were. But on the whole, a 16% growth in revenues and near 30% or slightly northwards of 30% growth in profitability would come out as a strong quarter. He joins us right now to talk about what he made of the quarter, the bigger picture, and the outlook ahead for the year. Puneet, great having you. Thanks for taking the time out.
Thank you. Thank you for having me, Neeraj.
So, Puneet, did it live up to what you had anticipated? Obviously, if I compare it to the very strong quarter four, for most companies, it might look slightly off relative to that quarter. But did this quarter live up to what you had thought of?
Absolutely. It's a historical strong quarter, the strongest Q1 ever. And, there is seasonality in our business. So typically Q3 is the strongest quarter. Q4 is the second strongest. And first half is weaker. But if in the first half you start having double-digit growth coming from a good financial year and a 30% increase in profitability, the management has to be pleased with the result. Of course, we all would like to have more and more and more, but I think had someone asked me, will you do 30% more profit after tax in Q1 6 or 8 weeks ago, my answer would have been no, it's not possible.
Got it. So what went behind this? And is this symptomatic of what could happen for the rest of the year?
Well, I don't know if the rest of the year the same. It could be higher given all the events that are coming. There is a Miss World, there is a G20, there is a B20, there is World Cup cricket. We are expecting the foreign tourist arrivals at some point to go back to the pre-COVID level and at some point to exceed that level. So I think the best is yet to come, and second half is obviously the best position for it because of all the events happening at that time. However, having said that, we are seeing relatively stable business on the books and increase in bookings. The window is very short. The booking window is not, the way we used to book hotel accommodation maybe 5 years ago or 7 years ago. So I think the booking window keeps getting shorter. So I think what we can say today of whatever has happened in the last 4 weeks of July is positive. What I can see in the next 4 weeks looks also positive. And definitely second half with all the events happening should be positive for the entire sector. And within the sector, if we are the largest hospitality ecosystem, we are very well positioned to benefit from it.
Well, so I'll come to the second half as well. I have a couple of questions there, but just before that, I saw this quarter, if I'm not wrong, while seasonally there were a dip, YOY, ARR and RevPAR both have improved. I went onto the website to try and look for the Epicure membership, and the rates have moved up 60% for the same product. So clearly there are tailwinds out there. How is that piece slated to move? I know events may do what it does, but in the natural course, how do you see that shaping up?
I think it would be fair to say that the rates on the domestic front had not moved in the last 10 years much.
Sure.
Because there was imbalance in supply versus demand. Now, with demand post-COVID outpacing supply and supply expected to remain constrained, your natural ability to charge increases. And also because your occupancies increase. And from what I'm told by most of the consultants in the sector, because they track all the inventory, we don't track, other companies' inventory or all pan-India metrics. But what they are saying is more than 50% of the supply side that is expected to come will be new markets or in tier 2, tier 3 cities, based on the infrastructure spend that the government is undertaking. So that also makes me believe that the traditionally strong 10 top markets of India should remain relatively stable, like Delhi, Mumbai, Goa, Rajasthan, Bengaluru, Chennai, Kolkata. And in most of these markets, you have a significant owned portfolio. So that should give us the operating leverage when demand is strong. and our asset light growth on the not like for like should keep helping us on the margin front. And that's how we have come so close to 30. I remember very well in Feb of 2018 when we gave the guidance we'll increase by 800 basis point and go to 25%. Not many people believed us. Now when we say 30 or 29.8 or 32.8, people want us to up it to like 35. But we are a capital intensive and we are a labor intensive sector. Important is to find the right balance in the increase, the optimization of both the top line and the margin. And we think we are very well positioned with the balance in asset heavy and the new model of management fee driven business to give the best possible returns to all our stakeholders.
Could there be an upside risk to margins, Puneet? I'm just trying to understand if indeed the input cost pressures stabilize and don't go up too much. There's a clutch of events. I was reading a note from one of the wedding companies which said that like to like, second half of this year has maybe 40% more wedding dates than what were there in the second half of the last year. Could there be an upside pressure to ARRs than what you envisage currently and to therefore operational metrics than what you envisage currently?
Well, firstly, I hope his prediction is right, that there are 40% more weddings because we'll benefit from that. Having said that, Neeraj, it would be fair to say that rates in India have been relatively low. Some of us also, by nature of our jobs or on leisure, travel abroad. We pay like 8-10x more. Even for a Taj in New York, the average rate is close to like $1,000. Average rate in London, if you're staying in the Buckingham Gate, is close to £1,000, and in St. James Court is close to £300. So I think this is very different rate structure. Now, we are not saying we'll get to $1,000 or £1,000, but at least 20% of that should be doable. I think we have this imbalance, and as India moves from like it's moved to the fifth spot in the economy and aspirational to third spot, I think all these things will change. Your salary structures will change, your cost to company will change, but also your ability to charge will change, and also the disposable income will change. It cannot be that the per capita income goes up, but average rates in hotels stay down. That's a mismatch.
Yeah. Sure. But hence, which brings me to the second part of my question. Since you are not just an ARR-driven company, events, F&B, do you reckon those could actually give a bit of a fillip to what is currently thought of as what margins could be and revenues could be for the second half of the year? Assuming that what I said about more marriage dates is true. I led it in a listed company's con call, so I believe it would be true.
Yes. So I think there is a direct and indirect impact. So direct, obviously, if marriage dates go up, if events that are happening are going up, then you have a direct benefit because they're happening in your hotel. There is an indirect benefit also. If there are more of the Pragati Maidans and more of Jio and more of Dwarka in Delhi as convention centers opening up, then also, even though they are not your assets, the demand that they will create an additional need for hotel beds and overnights, which will help the entire sector to get more overnights, which were not there before. So I think both the benefits are there in and I've said it very often, the infrastructure spend that the government is incurring has a direct correlation on the upside potential related to the hospitality sector, which will mean more jobs in this sector, which also means more indirect jobs. So I think all in all, it's absolutely win-win situation with the infrastructure development, with new airports, with new train stations, with the renaissance of existing train stations, highways, etc., making travel a more easy venture proposition or an easier proposition than it was the hardship of traveling maybe, let's say, 10, 20, 30 years ago.
Okay. Puneet, final question. In the last capital markets day, wherein you speak to investors and analysts, you upped your quote unquote guidance from what it was before that. The way things are going, is there scope for doing an encore at your next capital markets day?
Well, one thing which has positively surprised us is our speed of signings. I think we have added a lot of hotels to our pipeline, as you see also in Q1. We have added 11 new contracts. Now that's a very significant number. And today our pipeline is industry leading with 79 hotels, and the majority is on an asset light model or has operating leases for the Ginger brand. I think if that going keeps happening the same way, and that's the guidance we had up. We said 300 plus hotels, but we could end up having 325 plus in the portfolio with hotels under operation and in development. So definitely, if this trend continues and we have to give the next guidance, I think that would be based on the strength of the portfolio, which is not just hotels, which is also now entering into quick service restaurants with our Cumin brand, also on the homestay front. So it's a 360-degree customer value proposition, touching customer on all price points and in all experiences that are possible.
Well, keep up the good work, Puneet. Thanks so much for taking the time out, and all the best for the quarters ahead.
Thank you for having me. Thank you so much.
Was ours. And viewers, thanks for tuning into this conversation with Puneet Chhatwal of Indian Hotels.